Uh, just a second here. Have you all muted devices and so on, because I can't edit those away, like your phones or stuff like that?
It is mute, but I do hope you don't get interference in the sense of such sound. We had it also sometimes in the podcast in the past, but I'm keeping it away from the mic. It should be good, but I cannot turn it off because my daughter is the neighbors. My wife will get home soon, so.
Yeah, I see.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres.
Listen, guys, we have a huge guest for today's episode. Tonight's guest is an international star among dividend growth investors. He's been mentioned by Keegan as one of his main inspirations for the dividend growth investing strategy. Our guest is from the Netherlands, and he lives in Poland. He's known for creating the Noble 30 in Europe, which is a collection of European dividend aristocrats. He's also the host of the podcast Dividend Talk. We are pleased to welcome EuropeanDGI. Welcome.
Thank you, Farouk. I mean, I'm getting a bit shy from all of this. I'll never get used to that, I guess. But yeah, thanks so much. Really happy to be here. I'm really looking forward for today to have a nice discussion about dividend growth investing and yeah, to share a few words about myself, I guess.
Yeah, and look, we are a small group of people which are quite focused on dividend growth investing. And I remember 4 years ago, this guest we had called Keegan, he sent me a link to your blog, I think. And that's where I saw your Noble 30, where you can see the companies like Nestlé, L'Oreal, and so on. Can you tell us a little why you started this blog and what got you interested in dividend growth investing?
Oh, do you have an hour? But
yeah, we do.
Okay, good. Let me get started then. So because there are two different questions, maybe I'll start first with the why I got interested in dividend growth investing. Yeah, and then later I will talk about the blog because it can be nice shared in a sequence. Look, I never had the idea of being an investor or something like that back when I started working early 2000s. You know, I sometimes I saw my colleagues investing and they were the whole day watching at the screen while working. And, you know, I got affected by that. I put €200 in the stock market and I got nervous when it went like 2-3% down. Yeah. So in the end, after 2 years, I made nothing. My €200 became €190 or something like that. I saw it as a loss and I felt like, I shouldn't be in the stock market. It's way too risky. I'll continue saving. Now, fast forward, let's say 10 years later, at a certain moment you start to earn a little bit more, and at a certain moment you get some money left at the end of the month. Then you start wondering, like, hey, what to do with this? And at that moment in time, I read a really small book, which was about in Dutch, and it was about how a person paid down his mortgage. And actually, he wrote about this, how he was doing this, and then also how it gave him options, effectively, like working less or something like. And that inspired me so much because my mortgage rate at the time was almost 5%. And he learned me actually the concept of compounding, but in an inverse way. So he said, like, okay, if your mortgage is like €500 a month, you start paying, let's say, €1,000 a month if you can afford it. Then next month you may pay €495, and then let's say after €490, So I started doing that actually, let's say for a year. And then after a year, I just started to Google, like, because everything was on autopilot. I felt like, is there anything else here what I can do? I got a salary raise again. Everything was automated. And I just Googled, and then I came onto the blog of Dividend Mantra by Jason Fieber. That was in 2014. Yeah, and from that moment, I was just hooked on. When he started talking about passive income, replacing your own income with this, I was hooked. And while that was one thing, at that same time, and this really scared me. You come at the age at a certain moment that you start opening your letter about your future pension money that you may get when you're retired. Yeah, and that typically comes when you get children or something like that. After 10 years, just throwing these envelopes in the drawer, you start thinking maybe I should open it this year. Yeah, and then I opened it and I saw like, that's interesting. Inflation was like 2%, but there was no re-indexing of my future money. Then I started looking it up, and I noticed that over, let's say, over a whole decade, there was like 20% inflation, but there was only re-indexing of my pension fund of about 1.5% in that time. So I did the math and I thought like, oh my God, in just a single decade, and I still need to work 3 decades, I am like already like 18.5% getting less in purchasing power by the time I'm retired. I thought like, what's left if I turn 67? So, all of this kind of came together in one big soup in my thoughts during a summer, and came to me like, okay, you know what? I need to take matter in my own hands. And because I read that stuff about dividend growth investing from Jason Fieber, I thought like, I just need to get started, and that's what I did. And then, when you're reading stuff from others, you're starting to build your own portfolio, you start to, collect your dividends and everything. And at a certain moment, I thought like, why are there no Europeans writing about this stuff? Because, it is nice, all this American stuff. But first of all, we don't know many of those businesses. I made a few mistakes in buying them. And I just took my learns for like, I've been buying in this stuff and I actually don't even know what I own. Yeah, typical beginner's mistakes. And then I felt like, and because when I started investing, the US dollar to euro was still like €1.50 or something like that, and it went to €1.20. Yeah, so that was a big change in currency, and I had almost everything invested in the US, and I felt like, well, it can't be the case that there are no European dividend growth stocks. It simply can't. And that's when I started doing my research, and I found them, and I felt like I need to share this with the world. And you know what? I need to help removing barriers for European investors about whatever it is, taxes. I need to show them that you can invest in euro-dominated stocks, that there are stocks out there. Yes, there's a different culture, but we shouldn't shy away from it. Yeah, and if needed, we build our own culture. So that really inspired me to start blogging in the end.
Yeah, that's amazing. That's a really cool story, and I resonate really well with when you were saying that you had this realization that the pension you're getting when you retire probably won't be sufficient, because we're young now, but we're experiencing kind of a pension crisis in Norway right now. That our work minister has said that we may need to raise the bar for how long we need to work from 67 to 70 years. And that seems just weird when we have this really big pension fund, like Norway's have a really big sovereign fund, and that doesn't make any sense for us. So inflation is eating up a lot of our future wealth. So yeah, we need to take
But people are getting older. We're not dying all of us anymore at 75 or 80. People are just getting older, so we need more money. Secondly, costs in society are rising, and nobody wants to really pay the bill for this, or a politician doesn't want to pay the bill for this. So they rather like add some taxes to us. It's easier to take it from the people rather than making tough decisions to make budget cuts, because those are unpopular typically. So, the system is a bit against us as individuals, as the people, right? And while it should exist for the people. And I think in Europe, we're still really in a good situation. I mean, I'm so happy I don't live in America with the healthcare system and everything there. I do really respect that we have a social, safety net. Yeah, but I do believe that tougher decisions need to be made so that it's sustainable for everyone, for every generation. And I see big gaps there, and I worry even more about, I'm now early 40s, but think about the early 20 years. For me, it was already difficult to get a house in the beginning, but for some cities, it became nearly impossible. Then I thought I was the unfortunate generation, but the ones 20 years now, they are the unfortunate generation. So it means like in this whole generation, we didn't move the needle at all. We only made it worse, and that's not good. So, and I'm not going to put my faith in politicians and in the rest of society. There's one thing that I have control over, and that is what I do with my own money. So also, while, for instance, my employer puts 10% pension contribution every month into the social fund here for my future pension, I have discounted it to 0. I prefer this 10% to get to me, but then you get this thought like, okay, well, what if this happens to everyone? They will just probably squander the money, some of them, and then we have bigger issues in society. So I just see it as kind of a wealth tax, and I don't expect anything.
That's interesting, because I think like that as well. In Norway, I work for the government as a dentist, and they put away 2% of your salary to the pension fund. And I also look at it as money gone, to be fair.
Yeah.
But to get back to you and your blog, you have a barometer, like dividend divided by expense coverage ratio. You've achieved 56%, if I'm recalling it correct.
Yeah.
And
I need to update it a bit because it's a little bit more now, but I haven't published my annual report yet from last year. And then once I've done, but it will go more towards the 60%.
Congratulations on good results. But may I ask, what do you include in your expense coverage ratio?
My annual costs, so just the entire sum of annual costs. What I don't include are one-offs or something like that. For instance, what in the case, I don't know, you have a very large bill, because I will have that in the emergency fund. Yes, so I'll make sure that before I retire, I'll have an emergency fund that will stay there. I have a little percentage of the monthly income that is reserved for the emergency fund. But generally everything, so I know what my expenditures are, which includes everything, like typically the Maslow stuff of the Maslow pyramid, food, housing, you name it. Yeah. And how do I know that? Because I know what my savings rate is on a year. So let's say if your savings rate is 50%, which is my savings rate, and I calculate this on my gross income, which means like monthly income plus bonuses from work. So, and I know that I can invest from the net income, I can invest 50% each month throughout the year. So the other 50% I can live on. And in the last 4 years, I never had to bring money forward from my savings account or something like that. So it includes everything, also holidays, vacations. And I'm still wondering whether I should do this kind of slim financial independence, right? Where you're really on, when it hits 100% straight away, say like, okay, this is it. Or whether I build a margin of safety. I don't know yet, because with blogging and such, or when I do YouTube, you get a little bit of income, and that might be just that 10-20% margin of safety. The question is then, are you really like retired, or are you still working to some extent? But I will never be retired in the sense of not doing anything. I think also I will always earn some money. I'm not looking at it like that necessarily, but it's a question that I have around margin of safety still. I don't know yet. I'll figure it out. For now, this barometer shows my expense coverage ratio.
Yeah, that's amazing. I wish more people did that, because you need a long-term plan. And
and that's
great.
what I did. So, when I started, I just created such a calculator, like, okay, so my plan effectively is, right? I buy dividend stocks, and I didn't start with a 50% savings rate. It was maybe 15 or 20. Yeah. So I started with that, and my plan is that I need to buy dividend stocks with an average yield of investment of 3.25%, and on average they need to grow 6%. If I do that and I reach and I can at a certain moment do 50%, which I could do after 2-3 years, I had to get my finances in order. Then it would take around 15 to 17 years, and I'm on that track now. And actually, because of that, I didn't anticipate salary growth really necessarily like that. So there was a year, I think, during COVID that I was almost having a savings rate of 60 or 62%. So I took some things also again a bit forward, but then last year after the 70% inflation in Poland, I said I'll add another year to it because I couldn't consume that. So yeah, but it's about depending on how you do it. But let's say general rule is if you're able to invest 50% of your income, it will take about 15 to 16 years to reach your expense coverage.
Interesting mindset. May I ask, I think a lot of our listeners, which follow you as well, also wonder, how would you describe yourself as an investor? I know you're a dividend growth in investing, but would you say how are you screening for stocks? Because you have a lot of them.
So maybe the first question, I consider my a value-oriented dividend growth investor. So I'm not a dividend investor that says like, okay, based on 2 simple rules, I just buy everything that's in front of me. Yeah, I've got a dear friend on Twitter as well. His name is Alan, and he just has a whole system fully automated. And he's a high yield growth investor. Let's the stock comes up to 5%, he buys it. Yeah, and he has a few metrics in there that tells him the dividend safety. So I use a combination of value investing as well, but I will not use value investing to non-dividend growth stocks. First of all, I invest in stocks that have a safe dividend, and then I want to pay a fair price for it. And that means then also how I screen for stocks, right? For me, it's important that stocks in general have not got the dividend. I see it since the Great Financial Recession. That means that at least the Great Financial Recession and COVID has kind of tested their business models and shown that the companies are committed to the dividend. That's kind of very important for me. I'm not religious to it because some stocks have a story. Like I did just an article on Louis Vuitton. They announced a dividend hike in January of 2020 or February of 2020. COVID broke out, but they had their annual general meeting, and we saw that a lot of companies that had their AGM in May, they just couldn't do a dividend hike at that moment in time. There was so much public pressure there. The government was telling to companies, and even like formally to insurance companies, example, thou shall not reward your shareholders. As an example, you need to contribute to society. So for me, there is a little bit of a story to that. But I want those stocks. I want them very limited in my portfolio because it's really simple. If I'm living off dividends, I can carry 1 or 2 dividend cuts in a year, but I can't consider carry 20% of my portfolio cutting their dividends. Yeah. So yeah, that also means you end up with a very small stock universe, and which makes investing easier as well. You don't need to worry about all the rest.
You mentioned a little earlier that you were looking for more dividend growth investing in Europe. How would you say you're diversified? Is it more US stocks because it's more their dividend culture on increasing their dividends, or would you say your larger amount of portfolio is actually in dividend growth stocks in Europe?
So at the moment, I can tell you 52.6% is in US dollars. 34.5% is in euros, 3% in Swiss francs, almost 6% in British pounds, and then still some Swedish krona and something else. So it shows that like half of my portfolio is in euros and European currencies, and the other half is in dollars effectively. And it is already like 2-3 years around this number. So I think yes, there's still a large part in US dollars, and that will never go away because they have just an edge when it comes to dividend commitment to dividends. But yeah, I found a way to really mitigate currency risk and also find companies that I understand, that I know, that I have an association with, that I can touch and see when I go to a European city, and also can hear people talking about, as an example. And this gives me much more comfort in my portfolio as well. Because I learned over the years, you really need to know what you own. And knowing what you own is so much easier if you use the products or something like that. And if it's then supported with a really great management, with a good dividend policy behind it, in my opinion, you won a mini lottery when you have our investment strategy.
Yeah, that sounds great. So before I'm really curious on how you're picking the stocks for the Noble 30 list. But before that, could you just elaborate a little bit on the currency risk aspect of it? Because that's something we talk a lot about in Norway as well, because we have our own small currency, which fluctuates very much over time.
Yeah.
And it's been weakening very much lately against the dollar and the euro.
Yeah, true, and that goes in cycles, in mini cycles, and then maybe a longer term trend. I live actually not in the euro currency. I live in a Polish zloty, so I know exactly what you mean. But I still consider my portfolio a euro portfolio because in my mindset I'm a European. Even though I live already really long here, I still always. I mean, it took me 15 years to go from the Dutch gulden to the euro in my mind. Yeah, so maybe I'm a little bit of a slow responder to this. But also I trust a little bit in the euro more in the stability than in the zloty and in the strength of the euro. So I think it's first of all important that you make a mindset decision. Where's your currency? Yeah, and it doesn't need to be naturally the location where you live, I think, because maybe you see yourself living in Spain or something like that, right? In the past, maybe you believe in the euro more, on the longer term instead of the Norwegian crown. Yeah, so I think that's kind of a decision you need to make mentally, and from there, it's about dollar cost averaging, guys. I mean, you at least I can't predict how the currency will move. Also, I don't want to spoil my mind with geopolitics. Before you know it, you get into the YouTube algorithm and you start believing complot theories and all this stuff. So for me, it is like, if you don't know it, okay, then just dollar cost average and diversify. Yeah, and then you just mitigate the risk. I mean, you can hedge your portfolio if you want. It typically costs around 1 to 1.5% if you do that. If I'm aiming for a 3.25% yield on investment, I don't want to give like a third to half away to hedging my portfolio. It's not an option. So in the end, it's like, you just need to suck it up, and and if we don't want it, we need to live in America. Yeah, then it's easier. But I don't want to live there, so my investing style comes at a risk, at a cost. I mean, yeah. Because that's the thing, right? I see many people really they start like figuring this out, making really complex models, but sometimes I have a feeling this is just penny wise, pound foolish. Yeah, I think that's an English expression, and I think you always need to go back to the core of like, why are you investing? What is the biggest thing that can go wrong? Focus on that. All the rest, be smart in the sense of not like textbook smart, but streetwise rather. Yeah, and that's for me also been the most difficult because you learn all this in books, in theories, and you start to play with the formulas. But then actually, like for instance, hedging my portfolio. Oh, wait a second, I need to do this then, and then, and I may not forget this day because otherwise I have this. It just drives you nuts. Yeah, but if you then think like, you know what, if I just buy in a few different currencies, I believe in my country like Norway, I believe in the euro, I believe in the US dollar. Yes, there will be some fluctuations, but in the long term, it should kind of hedge out each other itself. Then just invest every month, and it should sort itself out. And if Norway collapses like Argentina, I think you have different things to worry about than your portfolio. You'll be screwed anyway. Yeah. Or buy gold. Yeah, buy gold, but it doesn't give you a return. Yeah, so because I hear this as well, like yeah, but what in the event of a war? I'll be fighting for my life. The last thing I worry about is about how Microsoft is doing at that time. I will be backpacking and with my family, and so you can manage for such events, and I think it's wise to do to some extent with your wealth. But I think by being on the online stock market, you've kind of secured it already to some extent, because you have invested in world-class businesses that have the ability to grow their earnings. Therefore, they can pay a growing dividend. You have done the business analysis. You have a good feeling that they can do it for another 10 years. Why worry?
When I listen to you right now, I understand why you're such a huge social investing profile and why you're so popular. Because what you're essentially saying is do the things you can control and don't use energy on things you can't
Yeah.
foresee or do anything about. So it's kind of really mature approach towards the financial markets, which I think is great and is the key for success, the long-term view, So quite nice points you got there.
Yeah. I just try to keep it simple, which is very, very hard. Yeah, and that's why I also share this stuff, because I think if I experience this, I at least hope, because people will make their own mistakes. They will need and they will need to some extent, and they will find out their own path. At least what I hope they take away from it is there is a path. Yeah, there is a path, and don't listen to your uncles when they say like the stock market is risky, better put it in the savings account. I mean, well, listen if it's a wise uncle to some extent, but at least I want to give a different voice that it is possible, because it is contrarian in Europe to be an investor and to be bullish on the stock market effectively, if you look at it from a general population point of view.
Yeah, I can vouch for that. We have the same mentality in Norway. It's very risky, the stock market. But yeah, this path, could you just elaborate a little bit on the Noble 30 and the process
Yeah, sure.
that you had to assemble the list and so
Yeah.
on?
So what I just did is I went to the stock 600, which is the European index with the top 600 companies. And I just started going to all the investor relation websites and just looking at the dividend page, and if they had and I just started to look at their dividend charts, and I could quickly see if they had like at least 5 years of a dividend hike or something like that, or growth, or at least no cut. And I put those all on a short list, and I had like 80 or 90 left after that. And from there, I started to look like, okay, I want to keep it simple with the index. I don't want to invest in micro cap or small cap. So I put there the target of 5 billion market cap, I believe, in there. And then you just filter down. And then I ended up with around 34 stocks or something like that at that time. 50, something like that. And then I started looking at the amounts of years. And I always said, like I mentioned before, at least the stock shouldn't have got the dividend before the great financial recession. So when I started that, I think there were like 35 stocks left, 34. And then it was like, okay, just put the first 30. And I think it finished with British American Tobacco at the time with 20 years or 21 years of dividend growth. And just put the cut there because I thought like 30 is a typical number that you can have a nice portfolio around. You can call an index here. So it is a bit arbitrary, but the Noble 34 doesn't sound. Yeah, so I felt like make it a Noble 30, but I also felt like it needs to be at least 5 billion or something like that in market cap. That it's, do you know the concept of slow compounders here? Yes, so that's very important for me. Like companies that really grow quickly, like we saw this during COVID, like Peloton, within half a year was a stock market darling, but it disappeared just as quick, because that means if they can do it in half a year, any company can almost do it in half a year. It means there's no barrier to entry. It seems to be really easy technology, and companies that build their business over like 20-30 years, they have been investing for 20-30 years. It means there are really high barriers to entry and such, and those companies you want to have, because you get so many signals before they go into trouble. Think about 3M. Yeah, you get so many signals. So and that's why it was important to have this barrier in market cap also for the Noble 30. Yeah, but it took a while. I've been spending 3 or 4 months on just going to every investor relationship website, and that's what I did. Yeah. And this
Yeah,
is the
that's great.
result. Yeah, this is the result.
Yeah.
So
So yeah, that's great. We're very happy that you did, because it's been giving a lot of inspiration to our listeners and a lot of investors in Europe, and probably a few Americans as well. I guess they own a stock or two.
yeah.
At least
So I
Jason
have some
Fiver
other
owns a few.
stocks. So I'm thinking sometimes of making a second list after the European Noble 30, like maybe like the mid cap 30 or something like that, because there are like for instance, take the small cap, but take Defama, this real estate company in Germany. The CEO is also active on Twitter. Really nice company, but it will never make it to the Noble 30 in the next 15 years because it will not reach that valuation like that. So I'm still thinking of also all those other stocks that I have now on my radar to also do something like that in an index. My issue is just actually time, because once you put it out there, you need to maintain it. Yeah, and that's sometimes the issue that I have.
May I ask, since you were mentioning 3M, they had their Q4 report yesterday, I think.
Okay.
And what do you think of companies? They increased their dividends last year. Me and Kenneth talked about it because
1
it
cent,
was so,
right?
yeah. It's so stupid, you know. It's so ridiculous, to be fair, because uh, it's so important to maintain their track record of dividend hikes, you know. So they are putting themselves in quite um, two-edged sword kind of
Yeah.
position, because uh, you can't have it both ways, if you know what I mean. How do you have any advice of how an investor can see the red triangle sign that, oh, this is not gonna end well, if you know what I mean? With your experience, how can you tell that a company like 3M or other companies will meet difficulties in the future?
To a beginner investor, I can't really explain that. And why not? If you can't read the financial statements, it's hard. And then you take your advice from social media. Yeah, I see a lot of trash on social media of people that were saying like, dividend investors, dividend growth investors, invest in medical properties trust or something like that. This MPW at $18, and I don't know, maybe it's trading now for $3 or something like that. Yeah, so there are a lot of yield traps there, and I can't. If people, I honestly think that people should not be stock picking if they are not willing to put in the effort to at least learn a little bit about accounting, let's say. And it doesn't need to be difficult, but at least buy a book about how to read the income statement, the cash flow statement, and the balance sheet. That's the most important, because if you are able to get there, and I tell you, if you have If you have a set of brains that with an IQ slightly higher than a monkey, it should be possible. Yeah, that's my assumption here. But you need to put the time in. You need to put the time in. And because if you don't want to put the time in, then just buy an ETF. You're screwed, because then dividend growth investing doesn't make a lot of sense with ETFs, because these ETFs that we have in Europe, they call themselves sometimes even dividend ETFs, but they don't pay growing dividends over time. That's also not how the indexes are compiled. Or you invest in an ETF that has like 1 or 1.5% yield, and in the long term you won't get financially independent with that. Well, in the very long term maybe, but not in 20 years. Yeah. So I think you need to do some homework. I mean, look, I don't want to really do a plug, but that's why Derek and I started a premium service where we are doing dividend safety analysis to help people a bit here. But let's take the case of 3M, because this is really interesting. And the question is, maybe back to you. Why do you think, because you say it's kind of so stupid, right? Why do you think management then continues to do that? What is their incentive?
It's to keep their stock price high and to maintain in those indexes like the Dividend Aristocrats. Because when you cancel or your dividend or you decrease it, you will get kicked out of the ETFs and the indexes that should track the dividend growth stockpile, if you know what I mean.
Yeah.
And
then their
also,
bonus is gone, right?
Yeah,
Their bonus
yeah.
is gone, and bingo. Yeah.
So, but I I have a thing for 3M. I am a dentist, you know. I use their bonding on my fillings and so on. So I love their products. And the thing is, I'm kind of a little upset because when you see a company like 3M with a long history and good products and so on, you have to admit they have been quite unlucky with the litigations, and you see the risk in the US. For instance, with Johnson & Johnson, that's one of my favorite holdings and one of my biggest positions in my portfolio. And you see those litigations hanging over the share price and the Q reports quarter after quarter after quarter, and you have the uncertainty. It's kind of draining your energy to be enthusiastic about those stocks as well.
So yeah, and you're right. So I owned quite a lot of 3M. I sold 2/3 of my position, not all at once, but I started selling last year because there's one learning that I had in my years. I don't want to have companies that suffer from litigation, where I can't get a good feeling for the exposure that they have. And for me, the PFAS exposure, and that's not the only one, right? They have also the earplug litigation with the war veterans. I mean, this is just so big that if they really get in, they can really get into trouble with this, really. And this is something also, Farouk, that how I always think. A good stock doesn't mean it's a good business, and a good business doesn't make it a good stock either. So I think we need to distinct those two. So yes, 3M has top-notch products. Everyone that uses their products knows this. Yeah, but management has put themselves in a risk, and you know, times change, right? Where maybe 30 years ago wastewater was kind of okay, but with the knowledge of today, society doesn't accept it, and court adjusts also to the needs of society. Yeah, so for me, there's no ceiling for this litigation. When we talk about G&G with talc powder, I kind of get a feeling that may cost like maybe 10 billion, 15 billion. We have seen some other settlements, right? So I've got a feeling with it. You look at the balance sheet, AAA, they can manage that. With 3M, I don't have it at all. So I don't want this in my portfolio. I mean, God's sake, you know, I've got Bayer in my portfolio. Can you imagine? I should have sold this long ago. And I saw, because I started building a position, and then they bought Monsanto. And I was so fed up. I thought, like, why a company like Monsanto? I mean, it may have good cash flow, but it has such a bad reputation, there will only come trouble from this. A year later, the litigation, and I thought like, value, it's value. Yeah, and look at where it is now. I could have sold it at 60, 65 euros. It went all the way down to 30 or 35 euros. I mean, it's horrible, So there's so many bad examples with litigation, and then you get the dividend cuts at a certain moment. I did an analysis of 3M. They have hardly cash flow left after paying the dividends. Don't look at the adjusted numbers that they're all the time reporting. And honestly, I haven't seen the Q4 numbers from yesterday yet. I do my homework usually in the weekend here. And I don't see, if they get litigation that I expect, how they can cover it. Because then I did a kind of a calculation. Okay, but then they will need to borrow debt. They will need to pay interest rate on that. That interest rate will reduce the free cash flow, and then the dividend will not be covered anymore. So I just don't see how it's sustainable. Token appreciation is nice. Look, I may be wrong. Maybe they settle it. Everyone is happy. I still have a small position in it. I will be happy with that. But I've learned from the past that if you have such litigation or fraud, like what we saw with ADM this week, I've burnt my fingers too much on this in the past, and I need to. If I don't learn from myself, then I'm not getting a better investor.
I think I couldn't agree more, because when I can tell you 3M had a lot of adjusted numbers yesterday. I looked at their earnings call, and I call those bullshit numbers.
Yeah.
So they have gotten quite creative, but you have to admit, when you let's say you're a new investor screening for stocks and looking for a company like 3M with their track record, that's a value trap. Even though it's a low PE.
And honestly, if you're becoming a stock picker, you will get burned on this. And I hope that investors get this, maybe not with the first stock that they buy, because that's where they need to have like this positive feedback loop, but please on the second and the third one, so that they learn quickly what their learnings are and not later on the journey. And everyone that is listening, I mean, I make mistakes still today. It's normal. You don't need every stock to be a winner. If you have 10 stocks, I'll give you an example. I bought Microsoft, right? When it was around 2.75% yield, probably in 2015 or 2016, around $40. Yeah, I bought a little bit there because I thought like, meets the numbers. I see something in the CEO. I see something in cloud. I think they have a nice vendor lock-in as such at many companies. They can probably easily sell it. I wasn't bullish on it. 8 years later, it's my biggest position, probably at the lowest cost invested. And this has compensated for my buyer loss, for my 3M loss, for everything else. And as a dividend investor, we don't even care about capital appreciation or depreciation. But I'm also trying to say, it's like having some losers in your portfolio is normal. You just need to know how to deal with it, because selling a stock is one of the hardest things for me. I don't know how this for others, but for me, because you fell in love with sometimes in stock. To your point, you're a dentist, you like the 3M products, yeah. So you have this association to it, and you almost need to be like a psychopath to some extent, that you don't have any emotional feeling to your holdings, while you still need to have this feeling that you know the products and know what you own. Yeah, and that's so hard, because in my opinion, investing is mostly psychology from that point of view. And so when it's a beginner investor, we have this quote on the Dividend Talk, and I really love to share that as well here. It's like, you can't borrow conviction. Don't take advice from the internet. Take inspiration from the internet. Do your own research, because then you buy with conviction. But when the stock goes down, you feel actually, oh, hey, I can buy it now 10% cheaper. Yeah, and you have also a better feeling at that moment in time if it is a value trap. So you can't borrow conviction, and that means you need to put your time in it if you want to do stock picking. And unfortunately for Europeans, if you want to do dividend growth investing, there's not much alternative compared to stock picking.
Yeah, this is a really, really important point. And this is also why it's difficult to be a stock picker, as you say, and the others that invest in index funds regularly every month, that they dollar cost average into different price points, and that's compounds really well over time. If you get afraid to these dollar cost average on a high conviction stock when the price is low, then you're going to miss out on returns. So it's really, really important to dig into what you believe in.
Yeah, but you need to put some rules in. For instance, I work with a tier system in my portfolio, right? So I've got classified 4 classifications. Tier 1 is my anchor. Tier 2 are really good. Tier 3 is like decent, and tier 4 is more like getting familiar with them. Yeah. So let's say that a tier 4 stock is €5,000 maximum limit. Yeah. So if that's it, I know that in a single year, I will probably not spend more than €2,500 on that stock. And if I reach that rule, the threshold, I don't invest anymore. I stop the dollar cost averaging there, even if I'm bullish. Why have I done that? Sometimes in the beginning of my investing journey, I averaged in too fast, yeah, and not having seen the risk. Now, for instance, I usually buy a few shares to get familiar with the stock. I keep it lying on the shelf for some time, and then after 3-4 months, I get a better feeling for it, and then my conviction rises after another quarterly earnings call. Because the issue is, if you for the first time discover the stock, you read the annual reports, you read the quarterly report, at least you scan a bit through it, right? It hits your criteria. You dial into an earnings call from the last quarterly earnings, and you think like, "Oh, this is it." Yeah, but you're just looking at one single moment in time. So I learned that I need several single moments in time throughout the year to really build my understanding of this. For instance, that you 2 weeks later see in the shop the product and actually think, you know what, I'll buy it this time. I'll try it. I try it at home. Yeah, this Unilever product, whatever. Yeah, and I've learned that I need to do that, because otherwise I go full in straight away. And have I been dollar cost averaging then or timing the market? You tell me, because you can buy your full position in 4 months. In the long run, over 20 years horizon, you've been timing the market, kind of. Yeah.
Yeah, that's really important as well, because you probably have the feeling that you buy and then it drops right after.
Always,
and you
always,
feel that always happens.
Yeah.
Yeah.
Yeah, true. And then I think this is normal for dividend growth investors, because usually there's a downtrend or something like that when we are buying, if we are value oriented. Yeah, because you are looking at the stock already for a long time, was always yielding 2.5%, and suddenly it climbs up to 3%. You think you buy it, and the next day 3.03%. Yeah, usually that was because there was already a downtrend in the stock anyway. So we probably feel like that because we're investing in for the first time in some stocks at a very particular moment there.
But wouldn't you say that since we're on DGI focused, that the dividend serves as a safety net, because you have a cushion of yield, so there is so much the stock can fall before the yield is so attractive. For instance, you can't get Coca-Cola for 4% dividend yield and a payout ratio of 60%. That's impossible.
Yeah, and that's what is one of the benefits of dividend growth investing. So I usually try to ignore the price charts for my own sake, because then I get anchored to where the price was maybe earlier, because it avoids you from buying as well. If you feel like, so imagine you do the analysis on stock and it's yielding 3.5%. And you think, oh, I want it, and then you open up on Yahoo Finance the chart and you see like, oh, 3 weeks ago it was yielding 4%. Maybe I'll wait for 4%. That's where I often missed out on stocks on this one. Yeah, so I call this chart porn. I love to create my own dividend growth charts of those companies, because it shows the stability of the growth, and it shows that the price is just a moment in time. It's important when you buy, but what I traded for yesterday, it doesn't matter. You can't turn back time. And if you use that as an indication for tomorrow, then you need to be a technical analyst. I'm not. It's very hard, but I try to avoid looking at price charts when I'm making a buying decision, actually for that reason, as you mentioned.
May I ask, you said you like the European profile when it comes to social security when you compare it to the US, for instance.
Yeah.
And you live in Poland, so you may feel the tension with what's happening in the East without talking about the politics. But let's be honest and get the facts straight. Russia did give Germany, the largest economy in Europe, cheap energy, gas and oil. And now with that gone, and the oil price is kind of having a floor at around $75 for Brent. How do you see the European economy expanding? Because in the US, they have access to cheap natural gas, cheap commodities because it's priced in the dollar, you know? So I kind of buy the narrative of buying abroad and not here in the here in Europe, if you know what I mean. Look at the chemical giant BASF. I sold it right before the war started, and I'm really glad I did. But what is the catalyst here? What is going to drive the growth? Because we also have the green.
I don't know, because I don't do macroeconomics. For me, it's a market of stocks, not a stock market. I don't have the mental bandwidth to do macroeconomics. I really don't know. I think, generally speaking, the US will be better off 20 years from now than where it is today. I believe that Europe will also be better off, probably a little bit less better off, but I think there will be progress. Generally, I think the fundamentals in society are strong enough. There continues to be investing, and that's enough for me. That's really enough for me, because if I start to do macro analysis, I probably will get worried about the crash happening all the time, because some things just don't look well. Yeah, I've been under investing in my early years in dividend growth investing, because in 2014-15 with Greek debt, I felt like the euro will crash and everything. I'm still waiting today. Yeah, if I would go on a hunger strike at that time, I would have been in big trouble now. So, I can't do this. And when you talk about energy pricing, well, we have cheap brown coal in Poland. I mean, I'm sure that Poland would love to export more. Yeah, but then you come into other elements of politics, as an example. Yeah. So, and that's why these stories are too complicated for me, Farouk. So I kind of try to ignore it. Maybe it is not smart, but it comes down to, again, the stuff I can control. And hey, if you want to hedge yourself against it, buy oil and gas stocks. Shell's my second largest position. When the gas prices went high, dividends started to increase significantly because Shell was able to buy back shares. So, you can also look at it from the other way. Just make sure that, ideally, my portfolio reflects in the same percentage as my consumption behavior. Ideally, because then I know if things change there, that prices go up, I know that the companies will benefit from it, and I will therefore also have my income growing as a result here. Ideally, it's really hard, but that's kind of what my thinking about it is. So, and that's why I try to avoid macro thinking in this space. It's maybe not what you wanted to hear, but that's how I look at this kind of stuff.
No, listen, European DGI. I love your answer. I love your answer because for me personally, I'm too obsessed with those things. It's actually background noise, to be fair, because it doesn't change. I'm never going to sell Johnson & Johnson because there is a war. I'm never going to sell ATD because there is a war. It doesn't actually affect my investment philosophy. So I don't know why I'm using that amount of energy.
It's because of it is because I know why, right? Because if you go to your favorite financial news website in Norway, I bet you it will be every day about this kind of stuff, because this is what analysts do at banks and such, and rightly so. This information is to some extent important because we know over the last 15-20 years what the Fed does with printing pretty much decides the stock market. What the Fed has been doing, and also the American government, they have been kind of bailing out companies, Europe as well, right? The too big to fail, or the airlines and such. So it is important to some extent, but hey, I don't own banks. I don't own airlines. So from that point, and actually for that reason, because I don't see those as sustainable business models. So I'm not trying to discount it to zero macroeconomics, but I know that I have limited intellectual capacity to spend time on investing. And for me, if I would need to rank it and prioritize it, macro is one of the lowest in priority that affects my stocks and affects the dividend growth of my stocks. And that's, I guess, what you also mentioned, Farouk, that it therefore becomes noise, right?
Yeah. But may I just ask you this more specific question, more company-specific questions? What is your 3 favorite parameters when you're looking at companies you want to invest in? Is it return on invested capital, PE ratios, free cash flow yields? What are your metrics there?
Okay. The most important is no, I can say the most important. Let's say 3, yeah, because it's hard to select. The first one is the dividend policy. What does management actually write in their dividend policy about it? If it is a payout from earnings, like 40-50%, that's not what I really like. I want to see more like something like progressive dividend policy, because I then know that the company is committing themselves to the long term. Because what I like about this commitment, it means that company has trust in their own ability to grow earnings. Yeah, so that's really important for me. That's such a kind of public declaration of the company here, and that should be supported with some dividend history. Yeah, so let's say at least 10 or 12 years of dividend growth. That one is a very, very important selection criteria, because that's what I invest for. Second one, I really want to see, and that's a snapshot in time, let's say, is the free cash flow payout ratio. It's very important to me. It doesn't apply to every company. It's a bit harder for a real estate investment trust. So then you need to look at their version of free cash flow, funds from operation, as such. That's one as well. And then the balance sheet. You know those in your personal finances. If you're like leveraged to the tits with your credit cards and your mortgage, then you know that this needs to happen in your income and you're screwed. By the way, I don't know if I can use this language, otherwise you need to beep it out. Sorry, but
It's okay.
that's okay, and that's how I also look at companies. Yeah, so you, for instance, take T. Rowe Price. Yeah, they it's an asset management company. ETFs in America. Many people have they invest in the 401ks there. They do this via T. Rowe Price. And suddenly the asset under management goes down. They go from a, let's say, 40% payout ratio from free cash flow to 90% payout ratio. And there you are. Will you sell it now because of the payout ratio? No, because it has zero debt. Zero debt. Companies committed to the dividend. They can easily, through the cycle, for the first time in years, get a little bit of debt. And then when they are in a better space again, pay it down. So balance sheet, strong balance sheet, free cash flow, payout ratio, and dividend policy. I do find return on capital employed important, but if I have to select 3, that one will be number 4.
Yeah, that's great. I'm always stressing the debt. That's really, really important. you can't pull forward. You can pull forward a bit of growth, but it needs to be sustainable and on terms that are good for the company in the long term, and never ever take up debt to pay out dividend. That's that's
Well,
easy.
actually, probably Texas Instruments is doing it now, right? I didn't check their earnings either, but there we know that they are investing for 4 years in new manufacturing plants and everything. Company communicated very clearly about it, and that's what you need. You need to understand what management is doing with this, right? Yeah, but to your point, otherwise you don't want them to borrow debt to pay dividends at all.
Yeah. Okay, so there are a few exceptions.
There are sometimes exceptions.
Yes, they have an A+ credit rating or something. That's very strong company. Yeah, but okay.
I remember. Sorry to just barge in here with a point here about leverage or debt to EBITDA. I remember European dividend growth investing when I bought Union Pacific last year. And Kenneth was like, "Are you crazy? Have you seen their debt levels?" And then I owned the stock, and it went really well. And then I was actually in the Netherlands, in Rotterdam, with my father, and he also loves the stock market and so on. And he had a look at my portfolio, and he said, "What the hell is Union Pacific doing there? Throw it out. Go out with the garbage." And literally, I sold Union Pacific at the bar, drinking Belgian beer in Rotterdam. It was a funny story. That's why I thought about it. It was worth mentioning it in the podcast.
That's a good one.
Yeah. So speaking of individual companies, do you have you gotta have some favorites, right? So could you mention a couple of favorites in the US and Europe?
Sure. And let me sneak peek a little bit in my own portfolio. What quickly comes to mind. So of course, Microsoft. Although it's not really attractive from a yield point of view anymore, but this company is just on fire. I consider a dividend growth stock, and I believe it would be good sometimes to have a bit like low yield, high growth in your portfolio to mix up. But I think I'm pretty much known in the community for Koninklijke Ahold Delhaize, which is a retail store in how is it in the Netherlands. Albert Heijn they have Gal and Gal. They also have kind of Dutch Amazon, which is called bol.com, but they also own grocery stores like supermarket chains in the US. 60% of their revenue comes from the US as well. I like that one a lot because it is a combination of dividend growth supported with buybacks, which kind of gives you a really nice combination there. So ticker symbol AD on the Amsterdam Stock Exchange. Last year as an insurance company, I like ASR in the Netherlands a lot. Very solid business, conservative CEO, outspoken on their dividend policy. 7 or 8% yield, growing the dividend again, double digits. In Europe there are a lot of companies that are not in the spotlights like in America or something like that, so they trade at better multiples. And then Johnson & Johnson, of course, that's the king for me in dividend stocks, but also Agree Realty, the real estate investment trust. I call that like the pretty little sister of Realty Income. So Realty Income is already at such a size that adding a few assets doesn't really move the needle anymore to support dividend growth, as an example. And Agree Realty still has that size that it can do that. Yeah. So that's really what I like about them. But those are just four that quickly come to mind, I would say.
Yeah, that's great. I've looked into that the Ahold Delhaize stock a few times, and I really like the diversity that they have. That they have several businesses at several places. It looks like it's very well run as well.
Yeah. What you need to know about supermarket chains, they have very thin margins, like 3.84%. So one thing needs to happen, and this can go in trouble. But we have seen Walmart, Target in the US, dividend kings. So I consider Ahold Delhaize with a lot of potential. We'll see, of course, how it goes in the future. But I always say it's not buy and hold, it's buy and monitor. Yeah, and then if the fundamentals in the business change, you can give them maybe 1 or 2 years to figure it out. But after that, if you lose your conviction, just sell it and buy something new. Yeah, you
I
don't need to
totally
wait until
agree.
it crashed.
I totally agree, because one of my favorite stocks in Europe, and especially in France, was a couple of years ago, Danone. Do you know the
Yes.
dairy company?
Yeah.
And they had
Yeah.
had great margins. They had great acquisitions, and suddenly their management shifted, and you're only there collecting dividend,
Yeah.
nothing else. It's like one of our staples here in Norway, where the management is actually screwing up the
Oh.
the, the market. They should
Yeah.
have thrived, but actually
Yeah.
are just an anchor and not doing
Yeah.
anything.
Yeah.
It's such a shame, to be
Yeah.
honest.
Well, to be honest as well, Danone is still my number 8 position. Uh,
Oh, sorry,
yeah, I
I
want.
didn't know actually that you owned Danone.
Yeah. I bought quite a lot over the years, and then suddenly they gave this tiny, whiny dividend cut. I hated it. But the CEO went out. The new CEO came in. And he was at the other company. He did a big transformation, very, very successful. So that's why I kept it in my portfolio. So it's also like I don't sell straight away if there's a dividend cut, but it's a very strong consideration. And with Danone, I gave them the benefit of the doubt, but you're right, it's been dead money. Yeah. So not the best performing stock, but so far they have been kind of recovering a little bit, and there is some sun on the horizon. But if it does this another year, then it will be out of my portfolio.
Interesting.
You were just wiser and quicker than me, and I applaud you for that.
Thank you.
Okay, so there's one thing that I wanted, you touched a little bit on it with the Ahold earlier on. Like to create a sustainable dividend, a path to a sustainable dividend, you obviously need revenue growth and have a big enough total addressable market that you can capture either market share, or you can do more stuff or do other stuff and earn more money over time. But we see also that there are a lot of companies that buy back stock, and that is good,
Mhm.
beneficial for propping up the price. But also you reduce your future dividend liability. So how do
Yeah.
you buybacks, is that part of your scope also, or?
Yeah, I pay attention to that, and with Ahold, that's why I find it attractive. Look, let's be really clear on this, because often I get in discussions on the internet with total return investors, and they say like dividends are stupid or something like that, because there's a misconception. What non-dividend growth investors, they think that all we care about is the dividend and nothing else. Yeah, I call that dividend investing, not dividend growth investing. So a company can do a few things with their free cash flow, right? They can pay dividends, they can buy back share, they can also reinvest in the business, they can pay down debt. It's really simple for me. First, they need to invest for growth. Yeah, and this can be via R&D, but this can also be via acquisition. I'm not such a fan of acquisition because most of the acquisitions don't deliver on the promise, and a company will not want to sell if they know that I say they don't get a premium. Yeah, so the cards are just stacked against you. So first of all, reinvest in the business for organic growth. That's the first most important. Then for me, it would be probably the dividends. Yeah, here. then it would be probably, first paying down debt. If the debt is too high, first pay down debt, then the dividend, then buyback. And then that's will be my prioritization, because why dividend first over buyback? Because I prefer cash flow into my own pocket, and I want that to be more sacred. And I see buyback as something additional. I wouldn't like it when the share price drops that they suddenly cancel everything and only start buying back dividends, and I've got nothing to eat in the evening because I was relying on those dividends. Yeah, and if you're a total return investment, you want it the way around. You want first buybacks and then dividends here. So that's, I think, the most different. But both together, as total return investors and dividend growth investors, we need to see the business growing first, because if the business doesn't invest for growth, we know that our dividends are not safe. So, and that's a misconception that I have often discussion around with total return investing. If you say dividend to them, they see it like such a red thing in front of a bull. They go berserk, and I always have to explain myself. Here I learned. Yeah.
We also get kind of assaulted actually by the same kind of things that you mentioned, the total returns, and that capital gains are more important than the dividends because the dividends are so small, because a stock can move 5% a day, you know, but the dividend is so slow. And the thing is, there is a stats here on Discord which show that low yield, high growth dividend stocks like Visa, MasterCard, and Microsoft, as you mentioned, and you own. What do you have any parameters or any? What is your lowest yield before you invest in them, or is that irrelevant?
No, it is relevant. So my general rule is not lower than 2.75%, because if you start buying stocks with 1.5%, they need to grow then, let's say, the dividend with 10-15% for the next 15 to 20 years. I don't know about you, but I can really not tell you if Microsoft will be able to continue this growth for the next 15 or 20 years. It's too much for me to imagine. I know that Visa has been doing this for the last decade and more, but tell me, which company do you think now of these high growers will be still growing with such double-digit returns for the next 20 years? Tell me, because I would love to know them. And you need to have relatively certainty there, right? If you invest in a 1% yielding stock, because at the moment it starts to hike the dividend with 5, 6, or 7%, 7 years from now, you will be looking not at this kind of yield on cost that you would need in 20 years from now, let's say 10% yield, to make a proper return out of your dividends, because your dividends need to, or you need to just invest much longer in capital into this. So there's kind of, for me, an optimum that I have seen is around 3.25%. On average. That's why the 2.75 is a minimum. But I sometimes break the rule. I just bought one share in Louis Vuitton. I did a deep dive. I really loved it, and I felt like, well, just let's buy one share, 1.8% yield. But this is more, how you say it. I guess this is more like of a token of appreciation for the business. It's and I did the same with ASML and L'Oreal. I just bought one share, but that's where I stayed as well, because it will not give me the dividend income that I need by the time I want to, let's say, retire from it or something like that. And honestly, I don't know if those businesses have this row, even ASML, right? ASML, the manufacturer. Do you think it can grow, for instance, with 15 to 20% for the next 20 years?
Look, the thing is, or me personally, I was more like you 2 years ago. I had to have at least 1.5% yield because I'm young. I'm just 31 years old. But last year I broke every single rule when it came to that. I bought ATD, which I have a yield on cost on 0.8%. I bought Dollarama with 0.3%, Murphy USA with 0.6%. And every every one of those stocks have increased their dividends, have a DAGR, a dividend average growth rate, of over 25% per year.
That's nice. That's nice. So you went from 0.8 to 1%.
Yeah, and and I love it. The
No,
thing
that's
is,
good. That's good. That's good. I mean, if it fits you, you should do it. Yeah.
But the thing is, the payout ratio is like between 6 and 9%. So you know that they can grow them at a large pace. Regarding ASML, did you see the numbers they put out today?
I have not seen it. No.
They were amazing, to be fair.
What is the dividend hike then? Because they should announce a new dividend, right?
No, I didn't see those stats.
Okay, good. They should announce it, I think, with the annual, but I'm not 100% sure. They went to a quarterly dividend there. No, I get what you mean, Farouk, and I think it depends again on your plan. Look, hey, guys, I will be living off dividends in 4 or 5 years from now. Yeah, so I don't need 1% yielders. I will be, if I start doing that, I will retire maybe in 6, 7 years. I don't need that. Yeah, and maybe if I have enough, if I have dividend income, and then maybe let's say the dividend grows more than what I need, yeah, then I can start playing around with low yielders, stuff that where I don't depend on the income for the next 10, 15 years, to your point. But even then, I always ask myself then, because you can plug it in, you can plug in the numbers, you just put in the calculator 0.8%, growing 15% on average for the next 15 years. Do the test. How quickly do you come to a 10% yield of cost? Yeah. And if it says to me, then 15 years, but it requires you to grow, I don't know, by 18% per year, then I ask myself, like, which company do I know that has been able to do this for such a long time? And then I filter on that. You get 2 stocks, maybe Visa or something like that. And then I think, like, what is the likelihood of all those 30 stocks that were growing at that starting point with that yield, that I will pick exactly that one that will do it for the next 15 to 18 years? And then I think, like, no, I'm not smart enough for this kind of stuff.
Yeah, I get what you mean. I get what you mean. So I also have one more question for you, European dividend growth investing. We are always asking our guests this question. What is your biggest mistake when it comes to investing, and what would you be telling your younger self with the knowledge you have today?
Okay, so my biggest mistake. So I've got a shitload of them, sorry. But most biggest mistakes were falling in love with a CEO. And this is so funny when I think about it. I invested in Tupperware. So it was like, who of our age does a Tupperware party? The people yeah, the people that were doing that in my family, they all passed away already by now. Yeah, so, but then I saw Tupperware party, hit my screener, 5% yield. I thought, oh, cool. I studied the CEO, and the CEO started talking like, we are empowering women in Indonesia by becoming entrepreneurs and everything. And I thought, like, whoa, I mean, I discovered the hidden gem. Yeah, Tupperware is not dead and everything. And so his name was Ricky Goings. I mean, already the name is so sleaze when you think about it, yeah. And he was talking about with such a passionate. And then quarterly report after report came in, like Germany is the biggest kind of sales market is declining again. It's kind of like nobody's doing Tupperware parties there anymore. And he was not talking about Germany at all. He was only talking about the women in Indonesia and the Asia Pacific. And there was hardly growth there, only stories. Yeah, I burned myself on that one, as you can imagine. But I was on time to sell it because I bought at 60. I sold at 48. It went all the way to 2.5, I think, like last year. So that's also, you're never too late to sell. So once you come to that conclusion, please sell. But also General Electric. Yeah, again, a CEO, Jeff Immelt, smooth talker, but they were just cooking the books. It's a miracle that they didn't end up in jail. But that's with me, that I fell in love too much with stocks and with CEOs at the time. And I had to learn not doing that, not trusting CEOs. Actually, you can admire CEOs, but the bottom line earnings, the GAAP earnings, they tell the real story for me.
And the follow-up question was, what would you tell your younger self with the
My
knowledge you
younger
have
self.
today?
That's, I mean, I find this really hard. So if I would be really able to be younger, and that there would be someone from the future actually be able to come to me, that such a thing existed, right? I would have loved to them to whisper in my ear just one thing, like dividend growth investing, and then just say like something like, study it, thank me later. Because when I was 20, 21, I was only chasing women and partying and studying. Yeah. So I couldn't care less about all of this stuff. But imagine having invested in 2000 or something like that, or in the late 90s in Johnson & Johnson, Coca-Cola and such, even just €100 or something like that. You're just going, not one night out, but just having invested that, like at least once a month from the 10 times that you went, that you at least sacrifice one evening and put it in dividend growth stocks. That's what I would tell my younger self, I think. Because I know where this question comes from, like advices and things, but you know what? I've considered myself so lucky that still at 33, that I somehow stumbled on Jason Fieber. I can't tell you even why. Yeah, the key was probably that I had some money left in the end of the month. Yeah, so I consider I consider myself like I won the jackpot. But how do you know what you don't know? Yeah, so that's for me always the hard one with advising your younger self. But I can only say I wish I discovered it earlier, but I wouldn't know what to say to myself to discover it earlier. Yeah, that's kind of so difficult with these advices. And if it comes to an advice, let's say, to what I would give to a person that's doubting or something like this with the strategy, I would, because one of the most difficult things in the beginning is putting your whole savings of a month in the stock market. Yeah, let's say you can save €300 a month. Putting this 300 a month in the stock market is very, very nerve-breaking. Yeah, I know this from many investors, also for myself. It's very, very nerve-breaking. So, and you need to get used to this kind of putting and deploying this money into the stock market. And that's what I would advise to everyone. Like if you don't have the balls for it, start with under €50, but start deploying a little bit on a regular basis, because you will know that your psychology changes and that you quickly get used to it. You can quickly get, and I think that's one of the most important things that people will need to get used to. And this doesn't apply only to dividend growth investing. This applies to ETF, index investing, total return investing, but getting comfortable with spending money that you would usually, that you know that you can use, buy really a lot of stuff from on a monthly basis. And I think that's probably an advice also I would give, like get used to this kind of behavior.
Ladies and gentlemen, European dividend growth investing. You have been such a thrill to listen to, and I'm starstruck really, because I've followed you for so many years, you know, passively, not ghosting or anything, stalking or such things. I urge our listeners to follow you on Twitter. You have over 22,000 followers. We will put out a link to your podcast and your Twitter account, or X as it is called now. And before we end this episode, we always ask our guests what would you like the episode to be called. But I have an idea. If I just can throw it out there,
Sure.
you can't borrow conviction with European DGI.
I like that one. That's one of my slogans. I even have it on a hoodie. We created a hoodie, Derek and I, and it has written on there, you can't borrow conviction. And I've got also a t-shirt that says bankers are wankers, but I wouldn't recommend that one as a title. But when we had Dividend Day in Frankfurt, and maybe you want to join, maybe this year we will do it in Warsaw. Maybe we can join communities or something like that if you have interest there. But I was so fun. I was walking around the ECB with a t-shirt, bankers are wankers. It gave me personal satisfaction to some extent. And I know it's a bit childish, but having seen what happens to the banks, how they have been bailed out, how they always get away with stuff, enrich themselves, I think I can be a little bit like a Robin Hood, like that. But I love borrow conviction. They could put it on my graveyard, on my stone. I wouldn't mind if they do that.
Great. Yeah, it's been fantastic to have you on European DGI. Absolute pleasure.
Thank you. I enjoyed it a lot. And thank you, by the way, as well, right? Not for inviting me, but for doing this for the community. I know that this is not anything that gives you money or something like that. I know that this is pure out of passion. I hope that some people sometimes donate you something like that to keep things in the air or something like that. But our citizens in Europe need this. The pension system is not sustainable, and I always applaud and I always want to collaborate with people that have that passion to help others out. So I'm really happy that I could come here, and I really hope that it helps you. And that helps you listeners, and that you really get the place that you deserve as a podcast. So please keep on going.
Thank you so much, European DGI. Thank you so much.